For most of my investing life, I had one simple rule: buy a low-cost S&P 500 index fund, don't touch it, let time do the work. And honestly, that rule has made me a lot of money. But lately, I've been going back through my portfolio and I've made 5 real changes. Not because index investing stopped working, but because of one thing: AI. Not AI as a buzzword, AI as a force that's quietly reshaping what's actually inside that safe, diversified fund you think you own. So in this video, I'm walking you through exactly what I changed and why. No hype, no doom, just the actual math. Here's the thing most people don't realize about the S&P 500. It's not 500 equal slices of the economy. It's what's called a market cap weighted index, which means the bigger a company gets, the more of your money automatically flows into it. And right now, a small handful of companies, the household names in AI, chips, and cloud computing, make up an outsized chunk of the entire index. We're talking roughly a third to 40% of your money concentrated in maybe 10 companies, all of them leaning heavily into the same bet, that AI spending pays off in a massive way. That's not necessarily a bad bet. But here's what got my attention. A lot of these companies are being valued not on what they earn today, but on enormous future revenue that hasn't happened yet. Some analysts estimate the combined AI infrastructure spending commitments already announced would require trillions of dollars in future revenue just to justify current prices. That's a lot of, trust me, it'll work out, baked into a fund a lot of people think of as boring and safe. So change number 1. I'm not abandoning the S&P 500. I still keep the majority of my stock portfolio there. But I looked into equal weighted versions of the index, where instead of the biggest companies dominating, every company gets roughly the same slice. It sounds like the obvious fix. The catch is that equal weighted funds have to constantly trade, selling winners as they rise and buying laggards to keep everything balanced, which racks up higher costs over time. So I'm not going all in on that either. I just shifted a modest slice of new money that direction, enough to trim my concentration risk without giving up the low-cost efficiency that made index investing great in the first place. Second change. I stopped treating the market as just the US market. Quick history lesson that changed how I think about this. Go back to the year 1900 and Britain was the dominant force in global markets, the financial capital of the world, an empire spanning the globe. If you were an investor then, betting against Britain would have sounded absurd. Fast forward, and that dominance faded. Same story, different decade, the late 1980s. Japan's economy and stock market were on an absolute tear, while the US was dealing with high inflation and sluggish growth. Plenty of smart people at the time thought Japan was about to take the lead permanently. Instead, the US came roaring back. The pattern here isn't the US is doomed. It's that no single country stays on top forever, and betting your entire portfolio on one market, even a historically strong one, means you're making a bet on that pattern breaking for the first time in recorded market history. So I added a global index fund to my portfolio, something that holds thousands of companies across dozens of countries, developed and emerging. Yes, if you look under the hood, US companies still make up a big chunk of it. That's just reality right now. But the difference is that a global fund automatically shifts if that balance changes. If growth moves elsewhere, my portfolio moves with it instead of staying locked into one country's story. Third change, and this is the one I find genuinely interesting. I started paying attention to smaller companies that aren't trying to win the AI arms race, they're just using AI well. Here's how I think about the market in 4 rough buckets. There's the crowded zone, the giant, expensive AI leaders everyone already owns. There's the defensive zone, the steady, reliable businesses people rely on no matter what the economy is doing. There's the speculative zone, hyped up smaller companies trading on excitement more than earnings, which honestly looks a lot like gambling to me, so I stay away. And then there's the zone I think is genuinely overlooked, Smaller and mid-sized companies quietly building AI into their products without spending billions developing the underlying models themselves. Here's why that matters. A lot of the biggest AI companies are betting that whoever builds the single best model wins everything. But the leading AI tools are getting closer and closer in quality to each other. When products become interchangeable, price becomes the deciding factor. And that's great for consumers, but tough for a company that spent tens of billions building something that can now be undercut. Think about how gas stations work. Most drivers won't pay double for a slightly better gallon of gas when the cheaper option does basically the same job. So, the value doesn't necessarily stay with whoever spent the most building the technology. And it often flows to whoever applies it the smartest at the lowest cost. That's exactly the profile of a lot of small and mid-cap companies right now. I'm not betting my whole portfolio here. This is a genuinely higher risk slice, but I've started allocating a small amount towards small and mid-cap funds specifically for this reason. Fourth change, I increased how much gold I hold. Big technological shifts don't just create winners and losers in the stock market. They create instability in the broader financial system. And I'm not the only one thinking this way. Central banks around the world, China in particular, have been steadily building up gold reserves for years, and that buying has accelerated recently. Gold has also recently overtaken US government bonds as the most held reserve asset among central banks globally for the first time in decades. That's a meaningful shift in how the biggest institutional players are protecting themselves. Regulatory changes have made it easier for banks to count gold at full value on their balance sheets, which is part of why demand has been climbing. I'm not predicting a crash, and I'm not going heavy into gold. It's a small, deliberate slice of my portfolio, split between physical gold I actually hold and a gold-backed fund for flexibility. Think of it less as a bet and more as insurance. Last change, and honestly the most boring but most important one, I'm holding more cash than I used to. The single biggest mistake I see people make with investing isn't picking the wrong stock. It's not having enough cash set aside, so when life throws something unexpected at them, they're forced to sell their investments at exactly the worst possible moment. Even legendary long-term investors have been building up larger cash reserves lately, not because they've stopped believing in the market, but because they're waiting for better prices before deploying more money. Having more cash on hand does two things. It protects me if things get rocky, and it means if the market does eventually pull back, and at some point, it always does, I actually have dry powder ready to buy in instead of watching from the sidelines. So here's my honest take. I'm not predicting a crash, and I haven't abandoned the strategy that's worked for decades. Most of my money is still in a simple S&P 500 index fund because if AI keeps driving growth, I want to be invested in that story. But I'm balancing that against the very real possibility of a bubble by spreading money globally, adding a small allocation to overlooked small and mid-cap companies, holding a bit more gold, and keeping more cash on hand than I used to. Nobody actually knows what happens next. So, instead of trying to predict it, I'm just making sure I'm prepared either way. If this was useful, let me know in the comments what you'd add or change, and subscribe if you want more breakdowns like this one. See you in the next video.